Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Sumera Abdi and Pavitra Parekh. Hi, girls. Good morning. Well, after a 650-point cut on the Dow Jones, about a 0.5% knock, 0.3% knock on the benchmark indices is not bad. The only problem is, after a subdued start, there was a big intraday recovery, and from there, in the last 1 hour, the markets have slid. So that's a bit disappointing that despite an attempt to pull back, markets have not sustained at higher levels. So as we speak, we're down about 50 points in the Nifty. The Sensex is lower by close to about 200 points, and a couple of these intraday charts will show you where the selling pressure has been. So Adani Ports, Bajaj Finserv, IT stocks are under pressure, TCS, L&T. The intraday chart will show you these are where the stocks are currently quoting at. Auto, on the other hand, continues to remain fairly upbeat. So Aisha Motors, M&M up, gaining close to about 2%. Commodities are having a good day. Hindalco, Tata Steel, JSW. On the mid-cap end of trade, some of the stocks which had phenomenal, fantastic, unexplained moves in the last couple of days are coming in for profit booking. So take up something like an EROS, a one-week chart of EROS. If you could get that, if I request the producer to pull that, that's today's performance, down 9%. A one-week chart of EROS will show you that the stock did very well over the last couple of days, but today it's seen a big downturn. And similarly for DB Corp as well, big mover yesterday, but today it's coming for some amount of profit booking. Hi.
Hi, good morning. So like you pointed out, we did see a recovery, although now it's we're back in the red. But for the Asian markets, there really hasn't been that at all, right? So whether you look at the Nikkei, the Taiwan markets, Korean markets, all of them are seeing sharp cuts right now, over 1% lower. So in that context, we're still holding up slightly better. Reema did mention the key auto names. If you look at some of the auto ancillary companies, those are also doing quite well. So whether it's a Lumax Auto, that one is up over 5%. You have something like a GNA Axles, Craftsman Automation, all of these doing quite well in trade. In addition to that, you have some of the larger pharma names. Of course, yesterday was a down day for them, but today you have them holding up quite well. So Cipla, Sun, all of these holding up. Apollo Hospitals as well in the green. And on the downside, it is actually the entire Adani group of stocks which is seeing some pressure today. So in addition to Adani Ports, you also have Power, Adani Green, Adani Wilmar, all of these seeing significant cuts come through. But for now, it definitely looks like we're seeing that global weakness reflect in our own markets as well.
Absolutely. And we have a lot lined up on the show as well to take you through, how to tackle all of this market action. Of course, stocks are edging up after a weak open, tracking a broad-based sell-off on Wall Street overnight. So we'll talk about the way forward for the market. Joining in will be Manish Kumar, CIO of ICICI Prudential Life.
IT slides as sector heavyweights cut variable pay to maintain their margin. JP Morgan downgrades its overweight ratings on tech stocks to neutral. More details are lined up for you later on the show.
Aisha Motors is the top Nifty gainer today. The stock has hit a fresh 52-week high. What's aiding this up move? We'll catch you up to speed a little bit later on the show.
And Maruti Suzuki exudes optimism over its hybrid tech partnership with Toyota as well as growth plans. Later on the show, we will get you excerpts from an exclusive interview with Maruti Chairman R.C. Bhargava.
And we'll also bring you a very interesting chat with Nestle India's Chairman and MD Suresh Narayanan on the demand scenario and the inflationary fears. All of this and much more lined up over the next 60 minutes.
But the big story that we're tracking today is on the IT pack. Infosys is the latest IT company to have slashed variable pay for its employees for the first quarter to maintain its margins. This is a Money Control exclusive. TCS and Wipro too, remember, had deferred or cut their variable payouts. Money Control's Haripriya Suresh joins us with the details.
In what has become an industry trend, Infosys is now the latest company to make changes to its variable payouts for the first quarter of FY23. Infosys has told employees that they will, on average, the employees will receive 70% of their variable payout, but it depends depending on what their pay grade is and what department they're from. It has attributed this to margin pressures, primarily because of compensation revisions that it has done, as well as talent that it has hired. This, of course, comes soon after both Wipro and TCS have made similar announcements. TCS has deferred the payout for certain grades of employees, whereas Wipro has said that anyone in band C and above will not be receiving their variable payout for this quarter. This, of course, for Infosys, its Q1 operating margins was at 20% and its attrition was at 28.4%. All of them are seeing significant increases in wage costs as well as increased attrition. And what the impact of this move will be on Infosys attrition levels remains to be seen.
Okay, that is the big story. Just want to put it in context. Now, remember, variable pay is based on performance. It's a lever that companies have by which they can actually adjust the overall compensation. But for IT companies, the variable pay is a small percentage of their CTC, and it is left to the company's discretion because, as I said, it's based on the performance. And also the fact that this time, maybe the variable pay has come down. Last year, they may have given 100%. This year, they're giving 70%. It also has to be seen in context with the kind of extraordinary salaries IT employees got over the last 2 years in this whole digital boom post-COVID. Now, take a look at TCS. TCS's employee costs as a percentage of their revenues pre-COVID in Q1 of FY19, which is when they typically hand out their salary hikes, was about 42%. As a percentage of revenue, this is shot up to 45%. So that's a good 300 basis points increase. That just goes to show you that companies have handsomely rewarded their employees in the last 2 years. And now that things are getting a little bit tighter, now that the startup hiring has also slowed down, perhaps the companies are looking to flex that variable pay lever that they have. Also, this point about margin is not unfounded. IT companies did come under a lot of margin pressure in Q1. Across the board, there were margin misses in the quarter gone by. For HCL Tech, TCS margins were at a 10 and 14-year low respectively. It was historical low margins for Infosys as well as Wipro. And even the quarter-on-quarter decline in margins will come up for you on your screen. So the point that we're making is that IT employees enjoyed a big raise in the last 2 years, and now that IT companies perhaps are facing some amount of margin pressure, they're flexing the lever of variable pay that they have. That said, again, it's not a very big amount. In the case of TCS, it's only a deferral by 1 month due to administrative issues. For Infosys as well, it's a marginal cut perhaps in their variable pay, but it's a lever which the companies can exercise based on performance, and they're choosing to do that.
Oh, absolutely. And Reema, thanks a lot for explaining that to us. In fact, it is this margin pressure that Reema was talking about, which JP Morgan has also cited as they've downgraded all of their overweight calls on the IT players to a neutral rating now. Nimesh is here with more details. Nimesh, looks like they're turning even more bearish on the sector.
That's correct. So, the global news flow, the domestic news flow and a JP Morgan downgrade has led to a big underperformance of all the IT stocks in today's trade. Now, the JP Morgan has turned further negative and underweight and bearish on the sector. And today in the morning, they've downgraded all the remaining 4 stocks which they were overweight on to neutral rating. The 4 stocks where they're downgraded are Infosys, Tech Mahindra, Emphasis and Persistent, all to neutral from overweight after the recent run-up in the price action. Now, they expect the margin erosion to persist in the medium term and stay meaningfully below the long-term trends. In fact, they see limited incremental margin levers going ahead for all the IT names. And in terms of valuations, the entire IT basket is still trading at least 40% higher than the pre-COVID levels, despite the fact that most of the peak growth is behind for all these companies, and margins are structurally getting eroded. So on back of this, they've turned further negative and underweight on the sector. And today they've downgraded all the remaining 4 stocks to neutral from overweight, which is Infosys, Tech Mahindra, Emphasis and Persistent.
All right, Nimesh, thanks very much for that. Earlier today, we also caught up with Nilesh Shah of Envision Capital. So let's hear out his take on the IT sector.
There's already been a significant price erosion. A lot of the froth which has been there is clearly gone. You have 2 sets of components or players in the IT services space. One are really the big boys, the large guys, the top 3, 4, 5 names. I believe they are likely to be under more pressure because they never had a very, very strong demand environment. At best, probably their revenues grew at about maybe 10 to 12%. And therefore, the impact of margin pressures will be more felt by them. Versus that, some of the tier 2, the mid-cap ones, the specialized players, I believe the demand environment for them, in fact, will get even better. Yes, that's quite possible, Anuj. I mean, clearly, if global equity markets are going to be under pressure, if the US tech space is going to be under pressure, if indices like the NASDAQ are going to be under pressure, it's quite possible that we would probably see some softening or moderation in the valuations. Maybe it's not time to be in the generic IT services companies and be in the specialized mid-cap tier 2 IT services companies. That's where the opportunity is going to be from a multi-year horizon.
Hi, welcome back. You're watching Trading Hour, and over to Manisha now, who's here to talk about the commodity space. And today she's focusing on gas prices. Manisha, morning.
Sumera, thank you. Morning for that. Morning and thank you for that. I'm looking at strong gains continuing in case of the gas prices. Well, if you look at the overnight markets itself, it has been nearly 10 to 20% of gains that we've seen into these markets. So the US natural gas prices now are trading at a 14-year highs above $9.8 per MMBTU. Last time we saw these kind of prices were in the month of Feb. When you look at the European Union TTF gas prices, they are trading at record highs. The UK gas prices are trading near record highs, which we hit in the month of March. So everywhere that you look, it has been a very strong jump up here. The trigger clearly comes in from Gazprom, which says that they are halting the flow of Nord Stream 1 pipeline to Germany for 3 days in the end of August. Remember, Nord Stream 1 pipeline in any case is working at 20% of capacity, and stopping completely for even 3 days in the month of August is keeping the prices on the higher side. It's not just that, you also are looking at strong demand of air conditioning coming in from US and Europe. Remember, there have been more than higher normal temperatures there. The heat waves that Europe has seen a lot of consumption for gas. And then apart from that, there's a lot of storage that we are looking at from Europe ahead of the 5th of December sanctions that they start from Russia. It also is about stocking earlier ahead of the winters there. The export from Caspian Pipeline Consortium at the Black Sea also have been halted. At least 2 pipelines that we know of are reported in media. So there are supply concerns coming in from more than one place. And then there are outages at Norwegian and UK gas fields as well. So supply is really under pressure. The US gas inventories also are nearly 12% below the 5-year average. So lower supplies, lower production, lower inventories are keeping the prices on the higher side. So much so that in the last 1 month itself, we've seen prices gain up by 13% for the US gas prices, but the Europe gas prices nearly 60% on the higher side. And this is the last 12 months in case of gas prices, 150% up for US gas prices, 400 to 500% up in case of the European Union gas prices, with the expectation that the kind of concerns we're looking at in sense of supplies, the next couple of years, the gas prices can still stay elevated.
All right, Manisha, thanks a lot for getting us that complete roundup on the gas prices. In fact, staying with the energy markets, as the crisis in Europe worsens amid a surge in prices, let's also listen in to what RBC Capital Markets' Halima Croft had to say on the oil and gas market. Listen in.
Well, I mean, Europe is going to be ground zero for this energy crisis. I mean, obviously, they are the main importers of Russian gas. The Russians have made it very, very clear they're going to continue to cut off gas supplies into Europe. We're going to have a 3-day outage on Nord Stream 1 starting on August 29th. But we can expect the Russians just to keep the pain up in order to try to force the Europeans to change their calculations about sanctions, about supporting Ukraine. So, yes, gas prices in the United States will also rise, but Europe is going to be really where the pain is going to exist with this war. Russia's only 3% down below pre-war levels. India's taking Russian oil. Turkey, China. What happens, though, on December 5th? If that European embargo kicks in, 2 million barrels of Russian oil isn't going into Europe. If those shipping and insurance sanctions kick in, it will be difficult to move those barrels to Asia. The question is Europe going to be in such a difficult economic situation that they don't go forward with those sanctions? To me, that is going to be the key determinant of where prices are. Europe's resolve to see this through in terms of Russia sanctions.
You're still tuned into Trading Hour. We have Mitesh Thakkar joining us for a technical check on this market. Mitesh, good morning and thanks for joining us. It has already been so wobbly, right? We saw that sharply lower open. It did recover and now we're pretty much, we're 25 points lower right now. So again, there's been quite a bit of volatility today. The mid-cap index is, however, still holding up in the green a little bit. Nifty Bank completely flat. How would you approach it today, and is there a trade that you would take?
Good morning. So basically, I think, we've been calling for this decline for the last couple of days, saying that the market is overbought. And I was looking at targets of around 17,400, 420 as the support area. We actually opened below that, but we have recovered. My sense is that I think if we don't close below 17,400, there's a good chance that we would have made one low of the pullback that's closer to the 20-day exponential average. And then you can see a consolidation before the markets kind of pick up steam again. So 17,400 is the level which I'm watching, hoping that if that holds, then 17,400 to about 17,800, 850 would be the range. And we'll see some kind of a contraction happening in the markets. With that, we're trading with long buys on stocks because after 3 days of correction, some stocks are now available with a good entry point and they are trading near support areas. So DMart is a buy or a long call. That's a buy with the stop just below today's low 41.70 and a target of 4400 on the upside is what I'm looking at. And a mid-cap stock, Shanti Gear, is breaking into new all-time highs. So that's a buy with a stop at 253 for targets of 290.
Thank you very much, Mitesh, for joining in. Let's shift our attention then to individual stocks. Aisha Motors is the top Nifty gainer. The stock has hit a fresh 52-week high. What's aiding this up move? Sonia is here with the details.
Thanks a lot for that, Rima. So as you rightly pointed out, it's been a big mover, not just today, but for the last many days. It's hit a fresh 52-week high today. The stock is up almost 33% in 2022. It's gained in excess of 10% in August itself. CLSA put out a note this morning where they maintain a buy, but they've raised their target price on Aisha Motors to 4154 rupees. They say that Aisha Motors is the top stock in their preferred basket within the auto space. Now, the reason for this is they believe that a lot of Royal Enfield bike owners will be replacing their bikes after a lifespan of 7 to 8 years. And this fresh demand will come through over the next 1 to 2 years. If Enfield can capture even 80 to 85% of this demand, it will mean significant gains for them in terms of revenues. Exports are also likely to be a key growth area. And they speak about how the EBITDA per vehicle for Aisha Motors has gone up substantially and is expected to improve further. Currently, the EBITDA per vehicle stands at 42,000 rupees. And because of the fall that we've seen in raw material prices and the operating leverage, the EBITDA per vehicle is expected to rise to 46,500 rupees, helping them in terms of a better operational performance. Back to you.
Sonia, thanks very much for that. Also, as part of our special series On the Record, Shireen Ban caught up with Maruti Suzuki chairman R.C. Bhargava, who says that the auto majors tie-up with Toyota will help access tech that cuts fuel consumption.
I think Toyota coming into this has very major significance for us. One, it gives us access to a number of new technologies. For example, this hybrid technology, which is now coming in with the Grand Vitara, is not a technology which is available anywhere else. But we will be introducing this technology, and it brings down fuel consumption by 35–40%. Toyota also has access to the bigger, more branded kind of car technology, so we can get those cars manufactured for the upper segment. So
the Lexus and
up to the Lexus quality if necessary, but in between also the Camrys and the Prius for the hybrids, and those cars are also available. So we will have Suzuki giving us for the Bharat market. And from Toyota, we'll get the technologies for the upper market. So that will give us the ability to cater to the full range of the market. And we will be able to find whatever we need to export. Toyota is looking for India to do some kind of production for their export markets also. As everybody knows by now, we have got the next site at Kharkhoda. And if all goes as planned, it'll become one of the largest single manufacturing sites anywhere in the world. 1 million cars are not manufactured in many places at one site. And I don't think Kharkhoda is going to be enough, of course. I think in another 3, 4, 5 years, we'll find we need to go somewhere else also.
All right, and down 27 points on the Nifty. The Sensex is off from the day's high considerably, but from yesterday's closing level, it's a cut of about 130 points. Markets are still trying to find their feet. First, there was that intraday recovery, then a sell-off, and now there has been a mini bounce that you can see on the markets. But the big picture is that in the last 3 days, we've seen the markets sell off. The peak on the markets was near 18,000 on the Nifty. So from that level, we've lost close to about 550 points on the Nifty at least. And overnight, we had a big sell-off in Dow. The Dow was down 650 points, and crude prices too have inched up now to levels of $97 per barrel. So that too on the sidelines is not positive for the Indian markets. But this week, we've got the expiry for the August series, and plus the Jackson Hole Symposium will start 2 days from now, Thursday to Saturday. But let's talk about where we are headed. Manish Kumar, CIO of ICICI Pru Life, is here with us to discuss the markets and the way forward. Manish, morning, and thanks so much for joining in. How are you reading the setup? Are we in for some difficult times? Could we see a deep correction in the markets?
Good morning, and thank you for giving me this opportunity. Well, if we look at the market behavior in the last few months, Actually, it is taking cues from what the US Fed is doing or is likely to do. So in the last few months, when markets were in a corrective mode, it was on account of the fears of constant rate hikes by Fed. In the last 1.5 months, when we saw a rally, that was on account of the belief that now that the inflation print is coming off, we are toward the conclusive end of the US Fed rate hikes, and therefore the markets had started rallying. Last 3 days, it is more of a correction of the rally that we have seen in the last 2 months or so, and it's more like on fears of what can actually happen on some of the upcoming events, which you also mentioned. On the one is on the Jackson Hole Summit, and other is that there is a Fed meet expected in the 3rd week of September. So given the latest data points which are pointing to somewhat lower inflation prints, but yet sustaining at higher levels, so one is wondering whether they will do a 50 basis points hike or a 75 basis points hike. So in a way, it is largely deriving cues from the US Fed.
Oh, absolutely. And we're waiting by for that Jackson Hole meet also, like you pointed out. Manish, good morning and thanks for joining us. This is Pavitra. So, you know, in this context, when there is fear of all of these rate hikes playing out, we are talking about recession fears and the demand hit. Where do you see the market trending from here, and how much of a downside risk do you think there is?
So first of all, as Indian investors, we should not be complaining about what has really been happening in our markets, because we need to understand that our markets are one of the best performing markets globally. And in a scenario or in an environment where global investors have sold off over 30 billion US dollars, yet our markets corrected by barely 10%. So in a way, we have been far more resilient than most other regional markets. Given that despite this kind of selling, we were just off by about 2 to 3%. Now, in the near term, as I mentioned earlier, we are going to take cues from what's happening globally as well as what is going to happen on the domestic front. So we have got 2 important meetings coming ahead. One is the US Fed meeting, which is expected in the 3rd week of September. This will be followed by the RBI action. And we actually expect a 50 to 75 basis points hike by US Fed. And likewise, we expect RBI to raise repo rates by 50 basis points. So it is quite likely that in the next 1 month, we'll see sideways to a downward movement in markets. But once these actions are priced in, I think one can once again start seeing a resumption of northward movements in markets.
Hi, Manish. Morning. So given the setup as you describe it, what is the portfolio positioning? Because till now we were seeing that it was large caps which were seeing, you can say extra sort of weightage in the portfolios. But given that, there has been this global correction, would you start finding value elsewhere, or is large caps the place to stay?
So when you look at our portfolios, it is again a function of the various I would say the investment charter of the various portfolios. So some of the portfolios that I am personally managing, they are focused more towards large caps. But we as a house, we also have certain multi-cap portfolios where we have a sizable exposure to mid caps. So I think at this point in time, there are good plays both in large caps as well as in mid caps. So it's more of a bottom-up calls that have to be taken rather than taking a market cap oriented call. Also, we have seen that whenever there is global sell-off, typically in the beginning, the large caps get sold off first, and then it spreads into mid and small caps. Similarly, whenever there is a resumption in rally, the large caps typically lead, and that is followed by mid and small caps. But over longer horizons, we would like to stick to the investment charters of the various portfolios rather than taking a call market cap wise.
Could you give us some themes which look interesting to you, perhaps are a little undiscovered? So for instance, bank has turned out to be a consensus favorite amongst a lot of these, people on the buy side. So could you talk about some different themes?
So yes, you are absolutely right that banking has been our favorite as well. And let me spend a minute there before I move on to other themes. So one is that we are in a unique situation where while the deposits are getting priced higher very gradually, on the other side, because of relatively sharper increase in the repo rates, we expect faster pricing of the asset side. And therefore, the financial sector, and especially some of the high CASA banks, are likely to report fairly good earnings for the next 2 quarters or so, or maybe beyond that. As far as other sectors are concerned, we are also positive on the capital goods and the EPC space. And there we have got, of course, a handful of companies. They may not be looking very reasonable on valuations, but the underlying construct is looking quite strong for them. Other than these two sectors, we have a positive bias for the automobile sector, but within that, we are positive on the passenger vehicle and the CV space. We are not yet so much positive on the two-wheeler space. If we are talking of some of the smaller sectors, we are there investors in the airlines space. We are also there in the organized retail space. So these are some of the niche schemes, niche themes where we are invested, and they have done quite well for us.
All right, Manish, another space I want to ask you about is the FMCG sector. I mean, I can see HUL as one of your holdings, but what else do you like in the FMCG space?
So FMCG space, so we are investors in actually many of the companies in that space. So actually, if you look at it in totality, not just as we refer to as FMCG, but even the companies in the spirits space, in the alcohol beverage space is something that we like, and we are investors there as well. So it is across the board, and we are also investors in some of the companies which historically have been beaten down for reasons relating to ESG factors, and they have actually done quite well in the last 1 year.
Okay, Manish, we'll leave it to that. Thank you very much for joining in. Important updates coming in from Tata Motors, where they aim to deliver strong improvement in the EBIT and free cash flows from Q2 onwards. Remember, Tata Motors Q1 numbers were a big miss. Particularly, it was the big loss from JLR, which surprised the street. But statements coming in from Tata Motors, where they are talking about improved visibility of the chip supply, and they're also focusing a lot on their cash flows as well as turning profitable. But we'll get you an interesting conversation now with Nestle India's chairman and MD Suresh Narayanan on the demand scenario and the inflationary fears which are coming up. But for that, you need to stay tuned.
Now some exclusive corporate opinion. Lata Venkatesh caught up with Suresh Narayanan, chairman and managing director of Nestle, to talk about the rural consumption trends, where demand is headed and so on. Hear him out.
Overall terms, I believe, as you rightly said, our negative volume impact, or in fact, our volume growth was fairly encouraging at 7 to 8% that we had. I think we made a conscious decision, Lata, to protect the growth engine, because it's very easy to take up the prices beyond breaking point and to really break the back of your business. And then when things start to normalize, as indeed one will hope that things will happen, then the growth engine will falter. So we really looked at a strategy of trying to protect the growth engine and make a balance between the top line and the bottom line. And in that, I think one of the things that has really helped us is that most of our categories, in fact all our categories, have grown quite well, and in fact across town classes. The heartening feature, and this is something that I think we had a chat the last time we met as well, is that India is opening up to Bharat for us. And I think that is something that's very, very heartening. We've had growth across small towns. We've had growth across semi-urban areas. And in fact, for quite a few quarters in a row now, we have been having growth in rural markets as well. So, but I must hasten to add, Lata, unlike some of my peer companies, which have got a higher play in rural markets, I have a relatively lower play. So therefore, possibly on a lower base, I'm still having encouraging growth.
But if you can add a little more nuance, inflation is still high as far as fuel is concerned. Yes. For rural India. Yes. Food, okay, it's moderated a bit, but still the disposable income, some people complain, some FMCG guys complain, is lower. So are you seeing that as a continuing pain or is that moderating?
Look, I think one of the things that still concerns me a bit is that while overall headline inflation seems to be easing out, and that's what most statistics are showing, still if you disaggregate it, fuel is down, which is good, and therefore for us it helps in both fuel and also in packaging material. But if you look at oils, the oil complex seems to be also going in the southward direction. We hope it remains for a while. Milk continues to be strong. Wheat continues to be strong. And as a consequence, and coffee is hitting well beyond the 10-year highs that we have faced. So therefore, in mixed terms, I still am a little bit worried about the underlying commodity inflation that is coming through. Now one hopes that with a good monsoon, hopefully some of the locally sourced crops that we have, in fact all of our crops are locally sourced, but nevertheless they are influenced by international prices, that there is some reformation as far as the international prices itself is concerned, which might help us. But food inflation is a matter of concern and we should be watching out for it.
So what I understand is that though you have statistical news of prices going down, it has still not begun to impact your actual raw material cost.
Yeah. You see, what's happening is that a lot of this is on a future basis, it's coming down. It will have to start hitting my consumption costs substantially for it to get reflected in terms of the overall results for the company.
Fair point. Now, one of the legs that appear to have done well for everybody is urban consumption.
Yes.
And now again, people would have already started placing orders with you for the upcoming or actually underway festive season.
Yeah.
Do you think that piece is good? Is it getting more robust? Just all the color that you can give on consumption.
Look, I think underlying urban consumption for us continues to be fairly strong. I think one of it, I hasten to add, is also because during the pandemic, this was the worst affected geography. The lockdown, as you know, had significant operational kind of issues across the large cities. Today that is coming back. And I think there is also a little bit of what I wouldn't call it revenge consumption, but if there is a word for it, there is a lot of consumption that is taking place, whether it is out of home, travel sites. I mean, you can barely, when you come to airports or when you come to tourist locations, you are barely able to find a room or in fact even to find a place in a restaurant. That's telling me that a lot of the consumption is coming back. Now, whether this will sustain itself over a period of time as economic growth starts to ramp up, time will tell. But at least the encouraging signs are, instead of finding empty shops and empty restaurants, one is finding super packed restaurants and also malls where you can barely stand.
Okay. So, which is doing better for you? Out-of-home consumption or in-home consumption?
Look, in-home consumption continues to be strong for us. But if I look at it in terms of bounce back, the out-of-home has been very, very smart. In fact, out-of-home consumption that had really collapsed during the pandemic has come back very strongly. And now, in fact, with all the sites opening up, most offices opening up, the IT sector also opening up offices, tourist sites opening up, I think all of this happening with also internal tourism being probably one of the best that we are having, we are seeing a very good traction as far as our out-of-home brands are concerned.
Well, quickly, let me wrap up and ask the big question. Pet care, you've got into that.
Yes.
Is that a sign that India is now progressing towards, fewer kids and the luxury of having a pet? And how big are you expecting this category to grow?
Look, the category itself is about 4,000 odd crores. So it's a fairly large category. I think what is attractive, Lata, is firstly, there are three criteria that we use. One is domain expertise. I think as the world's largest pet care player, we know what we're talking about, and I think that's good. Number two, in India, there is an increasing trend of pet adoption. So that is happening. Post-pandemic, it has gone up quite dramatically, either because of a sense of belonging or a sense of loneliness or whatever it is you can call it. Pet ownerships have gone up, and also even though if you look at the pet care as a share of the total food that is being consumed by pets is under 5%, but still the potential is large. And for many for many middle to upper middle class millennials and the younger generation who own pets, they want to give systematic, good, nutritious pet food rather than give them the food of the house. And I think that is also
Trading hour. Here's an interesting chat for you. India's largest winemaker, Sula Vineyards, filed its IPO DRHP recently. In its first interview post filing of draft papers, Rajiv Samant, who's founder and CEO of Sula, said that he expects over 20% growth in the wine business. He also said that the winemaker's FTA with Australia will lead to significant cut in import tariffs, but won't impact Sula's business. So listen into that conversation.
We must remember that, of course, we had a pandemic, so all these numbers that you talk about are very much pandemic affected numbers. One of the things I should say is during that pandemic, we really thought hard about what our focus should be. So we changed our priorities, refocused, pivoted towards our own wines, produced the grapes grown here in India and the wine made in India. And that too, our premium wines. That was a huge change in our focus. We used to have a pretty big imports business. We really pared that down, you know, so many supply chain issues, et cetera, We also had invested in a distributor and we hived off that stake. So what the figures don't show is that those businesses were hived off. If you take our standalone own wine business, the growth is much higher than the number you've referred to. And now moving forward, that's the way, that's going to be the base, is going to be our standalone wine business. That's really what Sula is about today.
Okay, how much is the sort of revenue growth rate on the standalone business, as you say?
So in the past year, the revenue growth rate was in strong double digits, over 20%.
Okay.
I don't want to comment on what's going to come in the future because you know that's we're going to just talk about the DRHP today.
Correct.
But for the industry as a whole, if you look at the industry report, the Technopack report, which is also excerpts of it are in the DRHP, it's forecasting extremely strong growth ahead. And of course, Sula being the market leader is the best poised to take advantage of that growth.
Correct. So, I mean, fair to assume not, you know, narrowing down to a number, but upwards of 20% growth on the revenue side is what the company expects.
It's fair to assume. I'm not going to say that that's exactly what we are putting out there, but you know, I would not refute your assumption.
Okay. As far as profitability is concerned, just correct me if I'm wrong, because I have the figures for the previous 3 years. You turned profitable in FY21 with over 3 crore profit. In FY22, your profit grew 16 times. Now, what I want to understand is what led to this strong growth on the bottom line. And 16 times, I assume, wouldn't be a sustainable growth rate for a company. What is that what is it that investors have in store when it comes to the profitability growth that you would guide them?
See, you've really picked out a couple of, you know, startling stats here. It should be pointed out that the base year that you're talking about was a pandemic year. As you're aware, India was one of 2 countries in the world, along with South Africa, where the government decided to stop all Alcobev sales for around 3 months. Obviously, that hit our business pretty hard. So you can't exactly take that year as the right comparative. If you take a look back, further back in history, actually we had strong profits. We've always been a strong, profitable company. Since year 1, I would say that 90% of our years we've been profitable and showing growing profitability. You're absolutely right that no company can deliver 16x growth in profits and do that again, but we do see some good profit growth ahead.
India is very close to signing this FTA agreement with Australia. Australia has a large wine industry of itself. They've been asking for reduction and significant reduction of tariffs when it comes to import or for them export of wines to India. Would this make the Indian industry very, very competitive for a homegrown player like Sula?
So we must remember that the early harvest agreement that you're referring to has already been signed. Now it needs to be ratified. So we're moving towards the Australian Parliament should ratify it in the next couple of months. In this agreement, yes, duties are going to come down significantly for expensive imports, which right now, just to put it in perspective, is less than 5% of Australian imports that it's going to come down. That's really going to expand the wine market at a much more expensive level. At this point, none of our wines is competing directly with these wines on which these tariffs are going to come down. So I don't see a big impact on Sula.
What is the duty that currently exists on imports of wines from Australia or any other country in that sense? And with this FTA with the Australian counterpart, how much do the duties, what is the say in terms of the duties coming down?
So the main impact of this is going to be on wines that cost USD 15 and above per bottle on a CIF basis. So just to understand that, these are wines that typically to the Indian consumer are going to cost 4,000 rupees plus 3.5. So very expensive wines. On these wines, yes, there's going to be a significant reduction from the current around 150% to down around 50%.
Australia is not a concern at this moment for you, but once this entire agreement process starts, India could be looking at more countries. I think one of the countries that again it's looking at is UK. There could be more countries which could be, in the fray for this particular agreement. Possibility that there could be some wines where the FTA would impact the range of wines which could be lower. Does that become a potential threat?
So the Australia FTA, the early harvest agreement, has set a precedent that we are very comfortable with, where we've reached at this point.
Correct.
If that precedent is followed, we are not, of course, we are always going to be aware, alert, but we're not terribly concerned with what might happen if the same thing happens. For us, it's the EU, which is the main one. UK, as you're aware, is mainly spirits.
Correct.
So UK is really, what we're talking about is whiskey and others, and mainly Scotch whiskey is the thing. In terms of EU, that's really where a lot of the wines come from.
All right, that is the word from the Sula management. They're sounding extremely optimistic on how the wine growth will pan out for the entire industry. And for Sula alone, we can perhaps see growth of around 20% going forward. So that's an interesting chat. But with that, we're completely out of time on this edition of Trading Hour. For the markets, it's absolutely flat, around 10% lower. It is a mid-cap index, which is trading in the green right now, just around 0.25% higher. So thanks a lot for tuning into Trading Hour. Halftime report will take this action forward.